Hi guys, this is Mark Shawson, the Pattern Trader, with your weekly video report for the week ending September 16th. And despite a very benign and even negative consumer report on Friday, we still saw an upturn in the US dollar for the week of last week. You can see that the week ended on a high note, and whereas I thought the US dollar was looking like it is rolling over, it is now looking like it has got a firming tone. There was comments about a week or so ago by one of the Fed governors indicating that the Fed was willing to or ready to raise rates in the near term. And that looks like is what is the undertone driving this market, that it appears that the Fed will raise rates sooner rather than later. Maybe in the upcoming 21st of September meeting, but probably more likely in December. So while it has been a fairly rough patch in the markets, hopefully we're seeing the beginning of light at the end of the tunnel. I know that the trading results for the last 6 weeks have been very dismal. And you can see that the market environment has been in this very tight trading range, and the results have basically reflected that. But it does look like we may be getting clearer to a path where we see light at the end of the tunnel in terms of a primary move one way or another. And it certainly looks, while it looked like the dollar was rolling over, we're starting to see a firmer undertone. I'm always a little bit remiss to handicap the market because when one week turns up, the other week has been the equal and opposite in the last couple of months. But if I look at these key reversals right here, we see this bit of a double bottom at this about 11,600 juncture in the dollar index, and then we see another smaller pattern here where we got this double base of support about the 11,800. So this is the one area that has been an overhang for quite some time, around the 12,000. And if we start getting up there and clearing there, it looks like the US dollar is going to be on a upward trajectory once again within the context of this primary up move, which I estimate has still got a year or two to run. So my expectation is that we should be seeing a firmer US dollar against most currency pairs going forward. In this chart, I'm looking at the euro US dollar. This is a weekly chart, and as the US dollar looks like it's pointing slightly higher, it now looks like the euro versus the US dollar is pointing slightly lower. We see a small little descending wedge pattern forming at the current level around the 111.50 area, and the next level of support is about 109. So the market has been trapped between 109 on the downside and about 114 on the upside. And we'll be watching these levels going forward. The market has been trapped for an extended time in this very, very tight trading range, but it looks like we could be getting some closure in these markets, hopefully in a sooner time frame than a later one. We have also been observing this uptrending wedge line that the market has been somewhat adhering to, and it looks like if we breach that, that could be a catalyst for lower prices. If we look at the context of the euro, the primary market is in a primary downtrend. We also look at these key reversals right here, which are pointing in the ultimate direction that the market is likely to head in. Now, I've been overthinking this, I think. I've been admittedly overthinking this thing. I've been observing this double and triple bottom here at this 105 and thinking that the market could hold at these levels and perhaps go higher. But at the current moment, it looks like this market is ready to roll over. And like I said, if we start taking out this upward trend line that has been in force and effect for quite some time, and we're at, despite where you want to draw these lines, we're pretty close to penetrating these trend lines that have been in force and effect for about a year now, and penetration below this could really open up a new move lower in the euro versus the US dollar. In this chart, I'm looking at the British pound versus the US dollar. This is a weekly chart, and again, the primary trend in the pound versus the US dollar has been much lower. Of course, we had the catalyst here for a huge downturn following the Brexit referendum, and now you've basically just been hovering at the lows post-Brexit. And I thought that there could be a chance where we had this small double bottom in force and effect, but with last week's key reversal, we see that so last week we made a new high and close on the low. That should have been a clue to watch for a further move, continuation move lower. Again, I was trapped into thinking that we could have some kind of consolidation, so I backed off. And as we saw in this week, the market substantially followed through lower. And now we're threatening this 128 price level where we made prior lows, and any penetration below this could open up a new path to 125, 120, and even 115. So again, we'll have to see how the prices react within this small support area. But right now, this market is starting to have a very heavy undertone to it, and it could give way in a big way to lower prices in the immediate time frame. In this chart, I'm looking at the US dollar versus the Japanese yen. This is a weekly chart. And in contrast to the dollar strength versus the euro and the British pound against the Japanese yen, it looks weaker. It has been weaker for some time, starting with this double top pattern right here at the 125 level. Once we gave way, this market has just been channeling lower. So we can observe that this market has basically been in a downtrend channel for quite some time, and it looks like now we're at the upper end of the downslope here. We do have the market looking like it's contained within this inside weak bar. So right here, last week, the high and low was within the high and low of the previous week, hence making it an inside weak bar. This represents a market coil. And just like a beach ball held underwater, once the market breaks out of this coil one way or another, I can expect that it will explode. And it looks like the future direction is still lower. I can still see that we're going to challenge the downward portion of this sloping channel, which would take this to at least the 96 area in dollar versus yen. In this chart, I'm looking at the Australian dollar versus the US dollar on a weekly chart, and to my mind, it's been a conflict of opposing patterns. So on one hand, we can observe what looked to be a double bottom pattern here. We can draw the neckline thusly. We had a re-challenge. It broke through the neckline, and now it looks like we're coming back to re-challenge this neckline at about the 74. And now it looks like we have an opposing formation on the top with this double and even triple top formation at about the 77 to 78. So we formed a great resistance area in the Australian dollar, US dollar. Last week we had this giant reversal bar where the market made a new high and closed on the low. These bars, as you guys know, to me indicate where the market wants to go. It's like a market that points in a certain direction. So for those of you that are not familiar, when I say a key reversal is when a market makes a new high and then closes on the opposite end, forming this reversal. And to my mind, it's the same thing as the market pointing in a certain direction and saying, I want to go this way. And so this key reversal a week or so ago with the key reversals here and here seem to indicate that there is a huge resistance area at the 76 to 78 area. The market is now rolling over, and penetration below this neckline at 74 probably will put this on a path to lower prices going forward. In this chart, I'm looking at the New Zealand dollar versus US dollar, and a little bit less clear than the Australian dollar, US dollar, where this clearly formed a nice double bottom. It then penetrated the neckline and then broke out, and now we're hovering well above this neckline. It's of 6,900. We're still at about 72.63. We do have resistance at about the 77 level, a little short of where it went recently, but again, late the week before last, we did have this reversal where the market made a new high, closed on the low, and now it's indicating that we are likely to incur heavy resistance at this level. Although, unlike the Australian dollar, I see that there's substantial support at current levels. It's going to be very hard for the market just to slice through all this previous, history to the left. So again, I'm a little bit unclear as to the direction of New Zealand dollar in the immediate time frame. It has put on this double bottom, and we could have a short-term hiccup at current levels, but I don't expect to see this thing sell off materially. So of all the currencies right now, the New Zealand dollar looks to be the strongest, and the way these markets are going, it could flip to be the weakest in the week following. So we'll have to monitor the action, but I think with all these currencies versus the US dollar, it seems that we've hit a major fork in the road, a major piece of resistance, and these markets are all looking like they're rolling over, and it's just a question of where we go. Do we slice right through, or do we go back into a protracted trading range affair? In the New Zealand dollar, it looks like that's more likely in the near term. In this chart, I'm looking at the US dollar versus the Canadian dollar. This again is a weekly chart, and consistent with the strengthening in the US dollar overall, we've observed a minor strengthening in the dollar versus the Canadian. In the last couple of weekly video reports, we've noted this ascending wedge pattern being traced out. Every week it gets a little bit more mature within the extended white space of this triangle, and at some point we can expect a breakout of this ascending wedge triangle. I did note in last week's presentation that this key reversal, where the market went lower and then closed on the high of the week, would likely be a continuation pattern in terms of this market going higher, which in this week it certainly did. And now we're knocking on the doorstep again of the upside of this ascending wedge. And so the question is, where do we go from here? I can certainly make the case for a breakout to 134 or 136. Now, these ascending wedges are not terribly reliable trading patterns, so I could also make the case for a false breakout, and we could see it go the other way. So we'll just have to keep our eyes on the price action out of this ascending wedge. There may be some easy pips on the table as this thing breaks out of this pattern, but we'll have to see how it behaves in the longer term. This is a chart of the dollar versus the Swiss franc, and in many of my previous presentations, we've been noting the price action of dollar Swiss being bounded within the lines of this symmetrical triangle. And again, as with all of these other markets, it looks like we're heading toward some kind of closure of these extended trading range markets as these markets make their way within these price patterns. So again, these price patterns give us great guidance over the long term as to where the next major turn is likely to be. So again, we still have some white space within this. We may still play around, and then hopefully we will see some kind of resolution of this pattern. And again, we always have to be vigilant and watch out for something that breaks out, gives us a false look, and then can go the other way. But for right now, we're getting narrower and narrower within this symmetrical triangle, and are likely to see some closure as to where the next major breakout is likely to be. And the good news, folks, is that we're getting closer rather than further away. I know it's been a struggle in the last couple of months, but you just need to hang in there, be disciplined, and wait for the next major move, and we will make back a lot of pips in that event. Now I'm breaking away from the FX markets and looking at some of these other commodities related markets. In this case, I'm looking at the US light crude oil market. This is a weekly chart, and as we can see, this market hit the upside resistance at about the 52 area, and it now looks like we're ready to roll back in the direction of the major trend. Of course, this market, came all the way from 105 down to 25. The market is in a major long-term primary downtrend. We can notice that it has effectively double topped in the region of the $50 area, and any penetration below this neckline will open up a path, I believe, to much lower prices. So if we penetrate below this $39 area, I think 35 is well within sight, then 30, and perhaps much lower. Based on the monthly charts of light crude oil, I've always believed that we are still going to see light crude oil go back in the low 20s over the long term. So this recent double top could be the catalyst to turn this market in a much downward spiraling direction going forward. In this chart, I'm looking at XAU USD. This, of course, is spot gold. This is a weekly chart, and we can note the appearance of a descending wedge bearish price pattern. This is something that I've been keeping an eye on for quite some time. We've taken a couple of nibbles at this market and have made some money, and been pretty unlucky on some trades where we got stopped out on the exact high of the day on two separate trades. So I don't know if I'm that smart to pick the exact high of the day, or there's a little bit of games playing in terms of stop hunting and things of that nature, and we got unfortunate and got our stops triggered at exact high of the day on two separate trades. Unfortunately, that's the price we pay in this game, and it's just part of the business. But again, I can expect that we may still see some behavior within this price pattern before we see a resolution to what's going on in gold. But hopefully, again, as with this market, as other FX markets, we're getting closer to a path to closure as to when the market will make an extended move in one direction or the other. And to my mind, this market is starting to look heavy. It has to me for quite some time, and we've just been unlucky in some of our trades. So I'm keeping an eye on this descending wedge. I just wanted to show you the descending wedge of this XAU USD trade on the daily, and much like the weekly, we can see it much clearer that it's becoming an extended flag pattern, a descending wedge pattern. It's looking heavier and heavier, and again, I can expect that we may get another false move at the support area, another brief jump, and then hope to catch a major move as we get clarity in this pair. I've historically done very well in gold, and hope to tag the next major move in gold, as it's looks like it's setting up for right now. The last market I'm going to take a look at is the U.S. stock indexes, in this case the Dow Jones Industrial. And you can see that the market recently broke out from an all-time high and now has broken back into the range, forming what could be a triple top. We actually have a little double top right here, and then another top right in the same area between the 18,500, 18,600 area. and now we're hovering just below the breakout area. So now the question is this double top, triple top formation something that could be very foreboding and an indication that this market is ready to roll over? Or is this just another continuation along the path of a very virulent bull market? So this is a market that's shown its ability to withstand a lot of shocks along the way. In this low interest rate environment, it's a home for investors, whereas there's not too many other places. And I don't know if that's going to be a sufficient argument going forward as to whether this market gets to stay intact or we eventually roll over. If the Fed does start raising rates and provide some kind of headwinds, we'll get to see the real strength of this market as to whether it still has the capacity to climb a wall of worry. So we're at a pretty key inflection point. This is a bull market. I think it's probably premature to write this off, but it bears scrutiny at this juncture as to whether this triple top pattern is going to provide a continuity to perhaps a trend line a little bit lower. So again, I'm not willing to make any definitive evaluation of the stock market at this juncture. It's a bull market until proven otherwise. I'm going to finish off this presentation by looking at the trade-by-trade results for the month of September. And while we started out fairly well in the early part of the month, last week was just a terrible week. I deliberately set the stop losses pretty wide on a number of trades to give it room. The market has been churning within wide ranges, and frankly, just putting stops in there within 200 or 300 pips basically, is guaranteed that you're getting stopped out one way or another. So it's not a panacea sometimes to put a stop loss. Sometimes you can die a death of 1,000 paper cuts, but we need to put them in somewhere. I was trying to give the market room to trade. Unfortunately, in the gold trade, we got stopped out at exactly the high of the day before this thing turned lower and is now below our entry price. So obviously a disappointment. Some of these pound cross trades look like they were going higher, and then with the consumer sentiment report on Friday turned tail with a vengeance, and now have completely taken another look to those trades. It's still too early to tell whether they're now going back and going to make new lows or still within an extended trading range. The only thing that I can say to you folks is don't lose confidence. I've been through many of these periods. I usually make my money in a few months of the year. You just never know when they're going to be. Typically, the middle quarter, June through September, is always the toughest in trading, and September, October, and then through February is usually the most robust. Hopefully, we're going to see a turn in the dollar and some direction in these trades. We've been looking at these patterns. They're getting closer and closer to some kind of closure where we can pick a direction and ride some trades and make these losses a memory. So again, I know for some of you that have not seen my trading or are used to this, it can rock your confidence, and I certainly understand that. If you're taking very low risks on these trades, so notwithstanding that we're got a fairly negative size pip total looking for right now for September, if you're assigning very small risk to your individual trades, you shouldn't be terribly hurt. I'm still only about 5 or 6% lower for this month despite this negative pip total. So the pip total and your percentages and your lot sizing hopefully will be reflective of a much more conservative approach, and that even despite taking such a whack in terms of number of pips, that on a percentage basis, it shouldn't have made a very meaningful difference to your portfolio for the month thus far. And again, I'm very confident that these patterns will rectify themselves and we'll be able to pick a direction and ride them for many thousands of pips and make these losses a memory. So again, if you have any questions, please email me at mark@thepatterntrader.com. I wish you a healthy and prosperous trading week, and I'll see you next time. Thank you. Bye-bye.